Hiya, this is Stephen from Cheltenham Tax Accountants. As it's the end of the tax year, which finishes on the 5th of April 2019, I want to take the opportunity to give some really easy tips that you can take to save some tax before the end of the tax year. So there's 5 really big tips I want to share with you today. So number one, the first one is more directed towards businesses, business owners, whether you're a limited company, a sole trader or a partnership. And you might have heard this before, but one of the biggest things you can do to save tax is to invest in assets, to invest in new equipment. So if you're thinking about buying that new computer, that new van, whatever that asset is for your business, make sure you get it in before the 5th of April, ideally by the end of March. That way you'll see the tax savings sooner rather than later. If you wait until the wrong side of the 5th of April, then it could delay the tax benefit for up to 12 months. So the next tip I want to share with you, and this is relevant for anybody, whether you're a business owner or not, is to basically utilise your tax-free allowances. So everybody gets a personal allowance with HMRC every year. You can earn a certain amount of income completely tax-free. And unfortunately, it's a basically a use it or lose it policy. You can't build up these allowances if you're not using them and save them for 5 years' time. So you need to take advantage of that tax-free income in the year what was given to you. So in 1819, that's just under £12,000, it's £11,850 completely tax-free. So you need to use any opportunity you can to use that allowance. So if you've got income that you can declare in 1819 as opposed to 1920, make sure you do that because it's going to be tax-free now. If you have to defer that income and it gets accounted for next tax year, you could be wasting up to 40% in tax, which could be costing you over £4,000 for exactly the same amount of income, but you've declared it in the wrong period. And obviously there's certain rules around when you declare the income, but that's a nice easy tip to make sure you use your allowances in the right year. On the same sort of subject of allowances, you get an additional allowance for dividend income, investment income. So if you've got shares in Sainsbury's or a PLC or your own limited company, then you can receive £2,000 of dividend income completely tax-free each year. And again, it's a use it or lose it type of scenario. So exactly the same advice with the personal allowance. If you've got the opportunity to bring that income into 1819 and get it taxed at 0% now, that makes much more sense than deferring it to next year and paying a far higher rate of tax. The fourth one I'd like to share with you is your basic rate band. So these are all linked. So your personal allowance, your dividend allowance, and your basic rate tax band. So everybody can earn the tax-free allowance tax-free. And on top of that, you then have your 20% for employees or 7.5% for dividend income tax bracket. So you can earn approximately up to £45,000 before you get into the higher rate for tax. And nobody wants to get into the higher rate for tax unless they have to, really, because we work hard enough as it is to keep the money in our pocket. We don't want to give it away to the tax man, really. So if you can avoid that 45k earnings threshold, and there's a number of different ways you can do that, and we're more than happy to share them with you. A real obvious and easy one is to basically invest in your own private pension to bring your gross taxable income down, but there are some other opportunities. So basically you want to limit the amount you're paying at high rate tax. Okay, so the fifth one, again, this is all connected, is the next bracket of tax is effectively, and it's a staff tax, is £100,000. It's a nice problem to have. Football players, and fortunately for them, they get into this bracket within a week. But you can earn £100,000 in a year before you start losing your personal allowance. That tax-free allowance I mentioned earlier, if you earn over £100,000, you start losing that allowance, and you actually lose £1 of the allowance for every £2 you go over £100,000. So if you earn £101,000, you lose £500 because it's half of the difference off your personal tax-free allowance, and that can make that effectively could be 40% tax. That can make a huge difference. Same principle again. Whatever you can do to bring your income down below that £100,000 bracket will make a huge difference. So that's the 5 major tips I wanted to share with you. And there's one bonus tip which is separate to income tax, and it's CGT, which is capital gains tax, you have a completely separate tax-free allowance for capital gains tax as you do to income. So you can earn 11,700, or you can make a profit 11,700 tax-free in 1819 by selling an asset and making a profit. So usually when we talk about assets, we're talking about homes, not homes, second properties, because the home you live in is exempt from tax typically, but a second property is usually subject to tax. So any profit you make on the sale of that property, or any profit you make on the sale of shares, and there are other assets, they're all taxable. So what you don't want to do is, I'll give you a really obvious example, is if you've got a share portfolio, you don't want to sell off and make a profit of £20,000 1 year and then have no sales in year 2. So you're effectively paying tax on everything above 11,700 on that 20k in year 1. Whereas if you could stagger the £20,000 sales and sell off 10,000 in year 1, 10,000 in year 2, you pay no tax whatsoever, and that would save you a few £1,000s. So it's a really basic, but it's an easy one that everybody can do. So I hope that's been helpful. If you want any more sort of proactive advice or anything specific for your circumstances or business, whether you're a client or not a client, feel free to get in touch.